On the way next, we're going to be welcoming up to the stage Milica Nikolic. She is from Fxview, and she's going to be talking to you how to trade like the pros. Milica, if you'd like to come up. Let's welcome Milica up to the stage. There we go.
Hi, everybody. Good morning. As we've identified, we could all use a cup of coffee, so I'll appreciate your attention today. My name is Mili, and I work in the brokerage department. I'm one of the directors of Fxview. I've been in the Forex industry for over 12 years now. Before that, I studied economics. I've got a master's in finance. And most importantly, I've been speaking to clients for over 12 years about trading, about the markets. And today, I'll be sharing some of the things that I've observed with you guys. Just to understand the room, can you raise your hand if you're new to trading? Who here is a beginner? Okay, so about half. Okay, so in case I skim through some concepts, I think it would be a good idea to go back to them to try to understand them, because a few people here have a better understanding, so I'll tailor it accordingly. So trading, you can be free. You can live and work anywhere in the world. You can be independent from routine and not answer to anybody. This is the life of a successful trader. Many aspire to this, but few succeed. Traders lose because the game is hard, or because of ignorance, or they lack discipline. If any of these trouble you, listen on. I'm going to tell you a story about a friend of mine called Roger. It's a true story. When I first met Roger, he was the owner of a small pizza shop on the outskirts of Sydney. He was into shooting, so he actually got his shooting skills to a very high level, and he was competing in the Commonwealth Games for Australia. And he decided to learn to trade because he craved financial independence. Today, Roger is a millionaire. He's trading for a living, and he's traveling the world while he is at it. But it didn't begin like that. I was actually beside Roger when he first started his journey. The first thing Roger did is he funded his trading account with $500. He decided that he shouldn't risk all of it, so he decided to risk $50, and he had a target profit of $100. He opened his first trade, and he got very excited. You know, you start to feel a lot of things when you open trades. So the trade started to go well for him. He had a profit of $20, $30, $40. But before reaching his target of 100, it turned around, so it started coming back down. And then he started to panic. Oh, I should have closed with a profit of 60. Anyway, the market started moving against him. As it was approaching his loss of $50, he thought, if I stay in a little bit longer and I change my stop loss, so I risk 100, maybe the market can turn around again and I'll have a profit again. So Roger increased his risk to $100. The market continued moving against him. He then moved his stop loss again until he was risking $250. And unfortunately, the market went in that direction. He held on, he was sweating, he was nervous, biting his nails, and the position closed with a loss. So then Roger thought, I'm going to make this money back. I'll open a much bigger trade. So he opened a bigger trade immediately after. In this trade, he risked the rest of his account, $250. And he was hoping for some good results. The market went in his favor. He had $30 profit. Boom, he closed it. He thought, it's better I take a profit than I take a loss. Let me take this. He had another few profitable trades like that, small profits, $30, $40. And then he had another trade in which he was on the wrong side of the market. And sure enough, he repeated the same thing he did the first time. He kept moving his stop loss, and he got stopped out and wiped all of his account. Roger's story is probably very common. I'm sure most of us here have done it, where you're feeling a whole bunch of things and making certain decisions which simply seem to be exactly the wrong ones. When you're trading in that manner, or as a beginner, you miss an essential element of trading, which is managing your emotions. So if you leave today with one message from me, that is about the importance of managing your emotions when you trade, realizing that you're feeling certain things, and whatever you do, don't act on those emotions after you open your trade, because that is the recipe for failure. So let's break it down. What did Roger do wrong? He had a target profit and a loss before opening his trade, but then he adjusted them. He decided to take a smaller profit than what he originally planned. He also decided to risk more money than he originally planned by moving his stop loss. He was very emotional throughout the whole thing, making decisions after opening the trade. He decided to risk everything on a single trade, which again is not a good idea because that means you just have to be wrong once in order to wipe your whole account. And he decided to try and make the loss back very quickly after. This is known as revenge trading, and this is really dangerous. So actually, professionals usually don't place any trades after they've had one or a couple of losing trades. They take a timeout because everything is about psychology and about emotions, and you don't want to trade when you're in the wrong state of mind. So the most important thing, when you start feeling a gambler's high coming on, or like a rush of hope or any emotions, is just get out, get away from the monitor, go for a run, go meet some friends, do anything, read a boring book. Just get yourself away from the screen and don't click. Some rules that can help you along the way, which Roger started also applying, are the 2 and the 6% rule. Now, you don't have to strictly use these percentages. It's the concepts behind them that are important. So the 2% rule says never risk more than 2% of your account on a single trade. So if you think about it statistically, we're all going to be right sometimes and wrong sometimes. Let's say a good trader will be right more often than they're wrong, but they will be wrong. So the important thing is that when you're wrong, you only lose a small portion of your account on that trade where you're wrong. So if you have an account, for example, funded with $10,000, don't risk more than $200 as your loss. So set your stop loss so that the maximum you lose is $200. Roger used to say, after he learned a bit more about trading, that if he loses $1 more than his traded plan, he considers himself a loser. So he was very strict, and it was a good way to live. The other one is the 6% rule, which says that you should never lose more than 6% of your account balance. If you add up the losses in your account in any given month, together with the amount you're risking on your open trades, they shouldn't exceed 6% of your account equity. Now, let's talk about getting rich quickly. Okay, it's one of the things that people love about Forex, about trading with leverage. It's very exciting. You want to get in. You've heard how much money your friend made, so you want to do the same. Unfortunately, such a thing doesn't really exist. And if it does happen to some people and they do get rich very quickly, the only reason it happened is because they took a huge risk on a trade and they happened to be on the right side of the market. But if you're risking all of your account on a single trade, the time that you will be wrong, you will get wiped out. It's a bit, it's really important to have realistic expectations about the kind of money that you can make. So what can help you with that is having realistic goals. For example, you can start off by trying to break even. So your goal would simply be not to lose more than the profits that you're taking. Believe it or not, this is a really good goal to have when you're starting out in trading. Once you've mastered this, and for weeks or months you're able to consistently break even, you can move on to the goal of capital growth. And once you're making stable profits over time, then you can become more aggressive and target larger profits. Einstein said that the definition of insanity is doing the same thing over and over again and expecting different results. What did Roger do after his initial loss? He funded his account again with another $500, and he opened another trade risking $250. And again, some of the times he was right, some of the times he was wrong, and he ended up losing his whole account. So he realized that something needed to change. Actually, we had a chat at that stage, and I told him that learning to trade is like learning anything in life. For example, if you don't know how to drive a car, you wouldn't jump into a car and start driving it on a motorway. You would first take some lessons, start to get comfortable a little bit, maybe on a parking lot, along with a friend watching you. Then you would progress through driving through the streets, and then you would get out onto the highway. So with trading, with learning how to trade, it's exactly the same as learning anything in life. You're going to get back what you put in. So the more work you put in and the more of a solid foundation that you build for yourself at the beginning, the more likely you are to become very good at it and to have success. So back to my friend Roger. He started reflecting about his mistakes, and he wasn't used to failing at anything. Remember, he was a successful self-made shooter. So he started thinking about shooting and his journey in learning how to shoot and what steps he took. And he was wondering if he could apply similar steps to trading. So the first thing he did when he was learning how to shoot was learn about shooting itself. He learned about the different types of guns that exist. He discovered, different shooting ranges around him. He found some clubs. He read books. He watched videos. And he generally tried to immerse himself in the space. So applying this to trading, he started talking more to people. He started asking more questions of his friends who traded. He started watching videos online. He was reading books about trading. He found that actually there were a lot of hidden gems in books, and I would agree with that. It's really worth spending the time. So you want to really get a solid basis of understanding about what the markets are and how they work before you get in. The next thing that he did with shooting was he tried out different guns to see what works for him. He tried shooting at different distances, and he figured out what was good and what wasn't. He applied the same logic to trading, and he was trying out different trading strategies. If you don't know what strategies are, it's really worth taking the time to learn about how trading works and how you can get different strategies. A strategy is just a trading plan, a way of identifying what trades you're going to place and when you're going to exit. So you need to play around a little bit with find the strategy that works for you. And like with anything in life, explore until you find something that's good. The next thing he did with his shooting was make a plan about when he would shoot, how often he would practice, how many bullets he would use with every single practice session. And he realized that he needs to have a trading plan with trading as well, especially if for no other reason than to control his emotions. Next thing was keeping a trading journal. He kept a journal when he was learning how to trade. This just like he did it when he was training for shooting. So in this journal, he wrote his reasons for placing trades, like why he would enter it, what his target profit and loss were, his rationale for exiting. He also wrote down in case he changed his mind during an active trade and if he adjusted his stop loss and take profit. And this later helped him reflect on whether he was trading emotionally or not. He learned not to pay attention to his emotions, especially as he was competing in the trading competitions. He would get very excited, he would feel nervous, but he knew that this was only going to work against him. So he did the same with trading. He became aware of his feelings, he had a trading plan, and then he didn't really care what he felt. As long as he was feeling something, he knew that he needed to ignore it, and he stuck to his plan. And obviously the last one being discipline. If you want to succeed at anything, like all professional athletes, you will see that they're disciplined. They keep practicing, they keep trying, they keep working hard towards it. So if you put the same logic into trading, you're going to get good results. Now, obviously, this didn't happen overnight. Like with anything in life, you tend to go backwards and forwards. Even if you look at price charts, they move up a little bit, then they move down, then they continue up. So he was advancing a little bit, then he would make some more mistakes, but keeping a journal helped him to reflect on his mistakes and made him realize where he was going wrong so that he could correct his course. Now, a few important things that any beginner trader should consider when starting out their trading journey are things like which broker you should choose to trade with. And we're exactly in the right place to talk about this here at the Expo because there are loads of brokers here, so you have your opportunity to choose. You want to check out the licenses that a broker has, because the more reputable a license a broker has, the more secure, let's say, your funds would be with them, and they need to honor certain higher standards of etiquette when dealing with clients. You might want to check the account types that they have. If you are Muslim, you might want to have an Islamic account on which you're not paying swaps. Next things that are really important are spreads and commissions. Yesterday we had some people coming to the booth who were asking us what spreads are and what commissions are, so I was planning to explain it, but since you guys seem to mostly understand what it is. It's really important to pick a broker who has tight spreads. The spread is the difference between the price at which you buy and the price at which you sell. As soon as you open your trade, the reason you see it red is because of the spread. So you want this to be as small as possible. The second common charge that brokers impose are commissions. And this one is a bit less in the focus these days, but you really need to look at this as well. So usually commissions are quoted per lot, and good commissions might be something starting from $1 per lot. Expensive commissions might be going $5 per lot. This is each way. So as you open, you'd be charged $1. As you close, you'd be charged $1. Next, you want to look at the swaps, which is what you're paying to keep your trade open overnight in case you get stuck in a trade that you're holding for a long time. You want to go with a broker who's not going to charge you for deposits and withdrawals, or where you're going to have minimal fees. Obviously, you want good support, so in case anything goes wrong, you want to be able to reach the broker and say, hey, check this out, what went wrong here? You might also be used to trading on a particular platform, so you can look for a broker who has the platforms that you like. And of course, if you're a beginner, you want a broker that has good learning resources so that you can use that to your advantage and tap into that. I'm happy to say that at Fxview, we actually score really well in every single category. True story. And if you have some other categories in mind that I didn't mention, come by our booth number 20, and we can chat about that as well. In fact, if you want to discuss anything that I mentioned today, we would love to meet you in person, and we have loads of giveaways. We have a spin the wheel, so there's cool prizes to be won. Other tips for trading. Opportunities in the markets are always going to be there. You might get excited and feel like, wow, I need to jump in now. This is really, really great. If you still haven't reached where you want to be at in your trading journey, it's better to stay out. You know, if you don't feel quite right about a trade, you know, you think you should be trading that, but you're not quite sure, it's better to stay out. You know, you can always take on a new risk, but you can't get your money back if you place the wrong trade. Next one is having a trading strategy. So this simply means that you have a plan before you enter a trade. As soon as you open that trade, you predetermine what you want to profit, what you want to lose on the trade, and you don't deviate from this plan. Remember, emotions are going to pop up and they're going to tell you, like, increase your risk or like take a smaller profit quickly, but this is really dangerous. In fact, one thing that helps is really becoming very, very disciplined and not letting yourself deviate from your plan. It's also important to have realistic expectations. So if you're expecting to double your account within 1 or 2 days, this is simply, you know, it's returns of like 200% within 2 days. This is completely crazy and unrealistic. You wouldn't expect that if you kept your money in a bank. Like if we keep our money in a bank, we might be happy with making 5% a year. So let's get a bit realistic about the expectations that we have. That will reduce the risk that we take. If we want to get rich overnight, then it means there's an extremely high chance that we're going to lose all the money that we're putting into it. It's also very, very important, and in fact, all the good traders that I know, they keep a trading journal, and they keep their notes, and they write down why they entered a trade, why they didn't, why they hesitated, and they reflect, you know, maybe a month after your trade has closed, go back there, because this is the way you're going to improve. You know, if you never reflect on the mistakes you made, you're never going to learn from them. The money management rules are also very important. So don't risk large chunks of your account on a single trade. Remember, like maximum 1 or 2% on any given trade, and take it easy. You know, if you're not hoping to get rich overnight, you'll be quite happy making smaller profits, but consistently. And if you want to be a long-term trader, consistency is key. It's much more important than, you know, having some amazing, huge, profitable trade, because that's actually super risky. The next one is never ever hope that the trade will end up being profitable. As the moment you start feeling hope, it means that you're emotional. And the best traders that I know are actually completely indifferent. They will place a trade, they will set their target profit, target loss to close automatically, and they will walk away from the computer, and then they might even forget that they're in a trade. So this is what you want to get to, where you want to get to. And you can by actually constantly working on yourself. I've got a very good friend who trades, and she's doing quite well for herself, and she told me that she learned so much about herself when learning how to trade, because she became aware of her emotions and the way that she feels in different situations. So do take a moment to shine a torch on yourself and like hear your thoughts and understand what it is that you're doing, because this will empower you for future trades. The next one is, usually, you really don't want to be going with the crowd. If everybody is talking about how the euro is a really good buy right now and how it's on its way up and how it's going to be rising forever, this is usually the time that good traders start selling it. I'm not saying go against the trend, because that can also be risky, but I'm saying don't be sucked in by mass mentality. If everybody's saying one thing and you've analyzed it and you disagree, this is actually a really good thing. So stick to your opinion. And finally, as with everything in life, the more you practice, the more the more effort you put into something, the better the results you get. So keep at it. Even when you've had a bad run, take a time out, reflect on what's gone wrong, and get back in the ring, and try again. But as long as you're managing the risk on each trade, you will actually be able to get back in and give yourself another fair chance. So I deliberately didn't tell you too much about Roger. Who is Roger actually? Roger is actually the average person that we see at this expo. He is you and he is me. He was just a normal guy. And if Roger could do it, anybody can do it. It will just take a little bit of adjustment of expectations and a lot of practice, a lot of work. So I wish you all the best in your trading. Hope to see you at the booth, and thank you very much.